Welcome to the session. Topic of this session is financial ratio. The agriculture project which are having the industrial component, the commercial component, they are assessed in terms of financial performance, and to assess the financial performance we prepare different financial statements such as balance sheet, income statement, cash flow statement, and actually to have more accurate and correct information, and to compare the different industries or the average of the industry, or to compare over the period of time, we use the information provided in the the financial statement in terms of the the financial ratio. Actually we calculate the financial ratio based on the information available in the financial statement, which provide more accurate or comparable information or figures. So we can compare the different industries, different firms, their financial performance. So in this session basically we are going to discuss about the financial ratios like income ratio, the efficiency ratio, the credit worthiness ratio. There are different types of ratio. So there are three categories: income ratio, efficiency ratio, and credit worthiness ratio. So we will be discussing about the importance, their calculations, their meaning in this session. Actually the financial information or the accounting figures which are available in the balance sheets and the income statements are compared with another the firm's figures or information for meaningful interpretation of financial information, and the relationship between the two accounting figures is called as a financial ratio. And the financial ratios are basically widely used to assess the financial health of an organization, that is the performance of an enterprise in terms of financial the viabilities, their efficiency, their credit worthiness. And to judge the financial position of a firm, whether it is improving or not, the firm's ratio need to be compared with those of its competitor, the industry average, or the company's past or projected performance. So we can have a judgment about the financial performance of a firm. And there are hundreds of financial ratios available that can be worked out, but some of the important financial ratios which are available, which are widely used, basically they are very important in the calculation and interpretation of the the financial information. And actually sometimes it is not possible to give the range within which the financial ratio should fall. Actually the analysis he has to form a judgment about the whether the ratio indicate the acceptable situation for the enterprises. So there is as such no range available, but the analysis, or they have to decide about the what should be the financial ratio of the figure of the financial ratio, and they form the judgment and interpretation based on their the understanding of the concept. There are different types of financial ratios, and basically they are grouped into three broad categories. One is the efficiency ratio, another is the income ratio, and third is the credit worthiness ratio. And I am giving here the balance sheets and the income statements of a dal mill. In calculating the financial ratio, we will be using the different figures, the information, financial information available in the the balance sheets. So I have highlighted the the figures which we are using in the calculation of the financial ratios in the brown colors, and so all these figures we will be using in the calculating the financial ratio. So this is the balance sheet, and then this is the basically income statement of a firm, of a dal mill. So here total revenue, total cost of the goods sold. So whatever the figures we are using in the the calculation of the financial ratio, I have highlighted in the different color. And now we move to the efficiency ratio. Basically, the efficiency ratio, they provide the judgment about the efficiency of the proposed enterprises. Actually, they provide the measurement of the assets used and the expenses control. So actually, how much assets we are using or how much expenses we are controlling. So basically, it provides the efficiency in terms of utilizing the less number of the resources and getting the more output from that the enterprises. So there are two common efficiency ratio we use in the financial analysis. One is the inventory turnover ratio, another is the operating ratio. And basically, inventory turnover ratio, it measures the number of times an enterprise turn over its stock each year. So actually, it is basically indicate the amount of inventory required to support a given level of sales. So like we have the formula for calculating the inventory turnover ratio. That is basically cost of goods sold divided by the inventory. So inventory is basically our production which is available in the firm or in the enterprises for the selling purpose. So basically inventory turn ratio, when we calculate for our dal mill example, so the cost of goods sold is 2,25,000 divided by the inventory, that is 1,67,000. So the inventory turn ratio is here in case of dal mill is 1.347. So so here how we can interpret this inventory ratio, that is also important. And for agriculture processing industries, generally the inventory turnover ratio is relatively low because of the seasonal nature of the production. Actually because the raw material which are produced in the seasonal, so actually we have to maintain the large inventory of the agro-based industries, the produce of the agro-based industries, so because raw material is available for a small period of time. So that's why we have to maintain large inventory in case of the agricultural processing industry. So here a low turnover ratio, actually it means that company with large stock in hand, and it has large inventory in hand, and low turnover ratio means it is finding it is difficult to sell the product in the market, and it is also an indicator of inefficient management of inventory, because we have large stock and which is available for selling, but which are not able to sell, and sometimes a large stock of inventory is to ensure that production schedule are met. So actually, in order to follow the production schedule, sometimes we have large inventory. And the another meaning of the low turnover ratio, that actually large fund is tied up through the sizable amount of this inventory. And high turnover ratio means that an enterprise is able to recover its inventory investment quickly, because they are able to sell in fast and in quick manner. So they are recovering their the inventory investment very quickly, and that also indicate that there is a quick demand for these products. The agro processing product, there is a quick demand, and there is a demand is there in the market. And it also means that the firm is in deficit of fund, because they are not able to produce this sufficient amount of the produce in the company or in the enterprises, because they don't have much money to purchase the raw material. So that also shows that they don't have the money, sufficient money, and they cannot afford to maintain the sufficient inventory. And sometimes it means that if they don't have the money to maintain their inventory, so it means they have to forego the sales opportunity available in the market. Then now we will move to the operating ratio. Basically, it is an indicator of ability of the management to control the operating cost, including the administrative expenses. And this is important ratio, very important ratio, to compare the overtime performance of enterprises and for the comparison with other similar industries in the market. So the formula for calculating operating ratio is operating expenses divided by revenue and multiplied by 100, which so that we can express in the percentage term. So in case of our dal mill example, the 2,98,000 divided by the operating expenses divided by the revenue. So revenue here is 3,50,000 and the operating expenses is 2,98,000. So 2,98,000 divided by 3,50,000 and that's come to 85.14. So increasing operating ratio, what do you mean by that? So it means that there is an increasing cost of raw material because expenses is more, then there is a problem of controlling the labor cost or input cost, and there is a wastage in the production process, So there is a no cut over the expenses with the declining, or also we can say there is a declining sale. When there is a declining sale, there should be cut in the expenses. That is not happening, and basically it is an indication that there is an increased competition, which necessitates that there is a reduction in the prices. So if there is a reduction, there is a competition in the market, so we have to reduce the prices, so there will be less revenue. So actually we should reduce this, the operating ratio. That is, basically good, examples or good results we want in a firm. Then another type of ratio we use is the income ratio, and here basically they provide about the long-term financial viability of an enterprises. And this long-term financial viability basically depend on the funds it can generate for reinvestment and for the growth of the enterprises, and also it's depend on the ability to provide a satisfactory return on the investment. And there are different commonly used income ratios are there, and the most commonly used the income ratio to judge the profitability of the enterprises are the return to sale, return to equity, return to assets. So return to sale is one of the important income ratio, and that shows how large an operating margin is there in the enterprises on its sale. So the formula here is to divide the net income by the revenue, and so here in our case the net income is 40,000 and the revenue is 3,50,000. So the return on sale comes to 11.428. So actually it means that we are the net income of the firm is 40,000 when the sale is 3,50,000. When the total sale is 3,50,000. So we are the net return to the company or to a firm is at the rate of 11.42%. And when there is a low return on sale means the lower operating margin, we are getting less margin, and it indicates that greater must be the sale to have an adequate return on the investment. So if there is a low return on sale is there, we need to increase our sale of the firm. Then the ratio is used to compare this ratio is used to compare the firms in the same industry or in the same sector and comparing the result of past operation and the future projection. Return on equity is another ratio, and it is obtained by dividing the net income after taxes by equity. So here basically when we divide the net income after taxes with the equity, we get the return on equity. So it means basically how much we are getting the net income based on our own investment in a firm or in a company. So in case of our dal mill, the net income after paying the taxes is 40,000, and the equity contribution from the owner of the firm is the 5,44,000. So the return on his equity or her equity is 7.35%. So actually this gives the rate of return based on the investment by a the owner of enterprises or owner of the the firm. Then return on equity, basically it most important ratios and is frequently used, and one of the main criteria for which entrepreneurs are guided in their investment decisions, and basically it is an indicator of the incentives for individual entrepreneurs to invest in a firm. Return on asset is another income ratio, and basically we found we can calculate it by dividing the operating income by the assets, and actually it shows the how much income we are getting, operating income we are getting by having total assets in a firm. So in case of our dal mill, we are having the operating income of 80,000 rupees, and total investment of the firm or the dal mill is the 6,97,000. So actually the return on assets is 11.477%. So it indicates basically the earning power of the the assets of an enterprises of a firm, which is vital for the success of enterprises. So in case of our dal mill, we can say there is 11.44% rate of return on the assets, or whatever the assets we are arranging for an enterprise. It shows their yield or is the power of return on the assets. Now we'll move to the credit worthiness ratios, and there are different credit worthiness ratio. They are very important to manage the financial risk. Basically they indicate the degree of the financial risk involved in enterprises. So they are important guide to the investors whether they should go for investment or not. They also helpful in indicating the efficiency or the ability of the entrepreneurs. They also shows in the entrepreneurial financial need, and they also show that the suitable terms and condition for arranging the financing for an enterprise. So it is used by the creditors or bankers or the financier to judge the credit worthiness of the debtor. So it is basically so about the financial ratios, the financial risk of the investment or of a firm, or it also shows that their ability to repay the the funds to the banker, to the financier again. So they are very important, and they are mostly used by the bankers and creditors. And there are different ratios like current ratio. The current ratio we calculate by dividing the current ratio with the the current liabilities. So here we compare the two figures. One is the current assets and another is the current liability. So in case of our dal mill examples, we have the current assets of 2,47,000 and the current liability is 53,000. So the current ratio comes to a 4.66. And for a credit agency, the current ratio indicates the margins the enterprise has for its current assets, and basically and it also shows the difficulties in meeting the current obligations. So basically it is very important ratio when we compare the current liabilities with the current assets, and shows whether the firms is in position to pay to manage the current liabilities with the available current assets. So in case of the current ratio, thumb rule is there, then it should be around 2. If the ratio drops to near 1, the enterprises is thought to be in an unstable position, and it is basically indicative that there will be difficulty in managing the current liabilities. He may not have the current assets or cash or money available in the bank to meet the current liability if it is around 1. Then another ratio in case of the credit worthiness ratio is the debt and equity ratio, and we can calculate here this debt equity ratio. There are two ratio we need to calculate. Basically it provides a range of the ratio. For debt equity ratio, we can calculate first the long term liabilities divided by the long term liabilities plus equity. Then another ratio we have to calculate is the equity divided by the long term liability plus equity. So, the debt equity ratio can be calculated as the proportion that long term liability have with the total debt and the equity, and the another ratio is the proportion that equity has in the total debt and equity of the enterprise. So, here in case of our dal mill examples, the debt equity ratio like 1 lakhs divided by the 1 lakhs plus 5 lakhs 44,000, that is 0.16, and the when we calculate with the equity, so 5 lakhs 44,000 is the the total equity, and the long term liability is 1 lakhs. So, for calculating another ratio, so 5 lakhs 44,000 is divided by 1 lakhs plus 5 lakhs 44,000. So, it's come to 0.84. So, it means the debt equity ratio is 16% to 84%. So, of the it shows the how much in the total capitalization of firm or enterprise, how much is the contribution from the debt or how much is contribution from the equity. So, here in case of debt equity ratio, in case of our dal mill, the figure is 16 to 84%. So, here 16% is the contribution from the debt, from the loan, from the the short term or long term loan, and the 84% is contribution is from the equity, means that is the contribution from the owner of the enterprises or a firm. So, there is no good rule of thumbs for the debt equity ratio, and basically in newly established firm the equity ideally should exceed the debt. So, there should be more contribution from the entrepreneurs than the money borrowed from outside. So, but such a conservative rules may not be appropriate in many developing countries where equity capital is scarce, when the entrepreneurs do not have sufficient money to initiate the setting of the enterprises. He basically depend on the borrowed amount, borrowed fund. So, in that case there will be more contribution to the debt than his own equity. So, in agriculture projects, enterprises are likely to need a strong equity base because a lot of risk involved in terms of prices and production in agricultural enterprises. So, it is always advisable to have more contribution, more ratio of the equity in the total enterprises assets. The another ratio is the debt service coverage ratio, and it is considered as the most comprehensive ratio of the credit worthiness, and it is calculated as the net income plus depreciation plus interest paid. The sum of these three is divided by the interest paid plus repayment of the long term loan. Or in case of our dal mill example, and the debt service coverage ratio is come to 2.92, and here net income is the 40,000, the depreciation is 28,000, and the interest paid is 5,000. So, sum of this three figure is divided by the interest paid, that is the 5,000, and the repayment of long term loan, that is the 20,000. This can also be calculated based on the the before tax basis and after tax basis. And in case of the before tax basis, we take the income figure before payment of the taxes, and basically it indicates the ability of the fund to satisfy debt obligation before such tax. And in case of the after tax basis, basically it is argued that the taxation is a routine and it is an unavoidable aspect of doing business. So, we should always calculate the net income by deducting the taxes. And here again there is a difficult to have rule of thumbs to take the decisions, and each element of the ratio is to be looked to have the judgment the likely changes therein from the projected amount. So basically there is no thumb rule. We need to look at the individual component of that debt service coverage ratio, and the declining trend in debt service coverage ratio indicate the over ambitious expansions of the enterprises or a firm, and persistently low ratio means there should be a consideration should be given to the changing credit terms to increase the repayment period. And now we can sum up this session that the various financial ratios are used to interpret the meaningfully the financial information contained in the balance sheet and the income statement. And there are three types of financial ratio: efficiency ratio, the income ratio, and credit worthiness ratio. Inventory turnover ratio and operating ratio are the commonly used efficiency ratio. Then return to scales and return to equity, return on assets are important income ratio we use, and the current ratio, debt equity ratio, and debt service coverage ratio are the important or commonly used credit worthiness ratio. And the calculation of this ratio is very important if we want to compare the projected or the proposed enterprises and with the industry average, or when we want to have the sound decisions about the financial viability of the firms, we need to calculate these ratios, and it guide the creditors, the promoters in taking decision, the right decisions about the proposed investment which are going to be taken place in the future. With this, I thank you all.